Welcome to the first PN Trade Options educational video. I will cover from options basic to advanced topic in short video. I'm Pablo Navarro and today we're starting with options 101. Calls and puts. What is the difference between a call and a put? A call gives the buyer the right to purchase an asset at a given price. A call buyer gains as the price of the asset increases. This means that call options are a bullish instrument. A put option gives the buyer the right to sell an asset at a given price. A put buyer gains as the price of the asset decreases. This means that put options are a bearish instrument. Buyers and sellers. The buyer of an option has limited risk. It is defined by the dollar amount paid for the option. The buyer of an option pays a debit for the trade. An example, if an Apple call costs $4 and we buy that call, that is the maximum risk we will have in this trade. The seller or the writer of an option has unlimited risk. The seller of an option has limited gains defined by the dollar amount received when the trade was established. The seller receives a credit. An example, if an Apple call costs $4 and we sell that call, that is the maximum amount that we could win on this trade, those $4. But still, we will have unlimited risk on the trade. Options expectation. For long calls, the expectation is bullish. The reason is we are long delta. Delta is a price component that shows the amount an option price will change for every dollar change in the underlying. We will talk more about delta in the next video. For long puts, the expectation is bearish. The reason is we are short delta. For short calls, expectation is neutral to bearish, since you are short delta and you are short theta. Theta is a price component that shows the change in an option's price as a time unit change. We will talk more about theta in our next video. Short puts, the expectation is neutral to bullish. You are long delta and short theta. For long calls and long puts, time is against the trade. You are short theta. Every day that it passes, your option will be worth a little less. For short options, calls and puts, time is in favor of the trade. This means that as time passes, your option will gain value. Here we have an example of stock versus option and how leverage affects your return on investments and how to use options to manage your amount of capital used. For example, if ABC stock is trading at $100 and we want to purchase 100 shares, that would cost us $10,000 and that would be the risk that we would have on the market. In options, if ABC stock is trading at $100 and we decided to purchase a call option with a 0.5 delta, that would cost us $10. As every contract of options represents 100 shares, we multiply 10 times 100 and we get $1,000 of capital at risk. If ABC stock increases by $5, our stock value would increase by 5%. Our option value would increase by 25%. You could notice here how we leverage our returns and also we lower the capital at risk. Rights and obligations. When long a call option, you have the right to buy 100 shares of stock at the given strike price. When long a put option, you have the right to sell 100 shares of stock at a given strike price. When short a call option, you have the obligation to sell 100 shares of stock at a given strike price. When short a put option, you have the obligation to buy 100 shares of stock at a given strike price. Here one can see that when long options, a trader has a right. He can decide whether or not to fulfill this right and when to do this. When short an option, a trader has an obligation. Whenever he gets a call, he must fulfill his obligation whether to buy or to sell, depending if he's short a call or short a put. Options terminology. Strike price. A fixed price at which the option can be exercised. In the money. A call is considered to be in the money when the asset price is trading higher than the strike price. A put option is considered to be in the money when the asset price is trading below the strike price. At the money. An option is at the money when the price of the asset is trading at the same price as the strike price. Out of the money. A call option is considered to be out of the money when the price of the asset is lower than the strike price. A put option is considered to be out of the money when the price of the asset is trading above the strike price. Here in this picture, we could see where the concept that we just talked about are located. You could see here in the middle all the strike prices. On the left side are the calls, on the right side are the puts. If you look, here's an Apple option chain. The 605 was the at the money option. Apple was trading at 605 when this picture was taken. So that would be the at the money options, both for the calls and the puts. For the calls, or everything below 605 would be in the money. This is because the price of Apple was trading higher than the strike price. Everything above 605 was out of the money. For the puts, everything above 605 was in the money. The reason is that Apple was trading below 605, meaning that the price of the option was trading above the price of Apple. Everything below 605 on the put side was out of the money. Options terminology. Intrinsic value. The dollar amount and option price is in the money at any given time. Example, ABC stock is trading at $40. A call option with strike price of $35 would have a $5 intrinsic value. Extrinsic value. The dollar amount and option price is out of the money. Can be considered as the premium being paid. Here's how you get it. The option price minus the intrinsic value equals the extrinsic value. Again, option price minus intrinsic value equals extrinsic value. Volume. The number of contracts traded in a particular day. Option interest. The total amount of contracts open for a particular asset, strike price, and date. Options trading terminology. Buy to open. When an option is bought to enter a trade, a trader gets long an option. Buy to close. When an option is sold to close his position. Sell to open. When an option is sold to enter a position, a trader is short an option. Sell to close. When an option is sold to close his position. Thank you very much for watching this video. Please send your feedback, comments, any suggestions will be more than welcome, and wait for the next options education video will come up shortly. Thanks.